Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next, let's say, 20 minutes here on Options Guy TV. A little bit of technical difficulties is the reason why we started a little bit late here, but we are rocking and rolling, and so is the market. Lex, just a lot of news, a lot of earnings. Like, this is the week to be in the markets, and the stock that we set up on Friday was PayPal, and I've kind of mentioned trials and tribulations of PayPal. I don't think they get the respect that they deserve in the marketplace. They've lost some share, but they're really battling back strong. I'm kind of thinking they'll have a solid earnings report going into this quarter, and they're going to be announcing tomorrow. So the trade that we set up was an open wing butterfly. And what we did was we looked at buying the 81 strike call. Well, this is actually the August 1st expiration, which is 4 days away. We're buying the 81 strike call, selling 2 of the 84 strike calls, and then buying 1 of the 86 strike calls. Now, we put this together and we paid, we're about even on the trade. So if you didn't put it on Friday, the opportunity is still available. And as usual, they're going to be announcing in the morning tomorrow. So normally you would put an earnings trade on a little bit closer to that earnings report. Now, if ultimately you are bullish on the underlying stock, you might ride it into earnings, which we actually did in Google, right? We did a trade the day of for Google's earnings, but we had a longer term bull call spread on Google, just because in general we're bullish on Alphabet, to say it a different way, right? And both of those trades worked out well. And you have your ups and you have your downs. But last week we had a really good week with a lot of the trades that we did. That bluntly, and this week I do like the PayPal trade. This is an alternative to just a long call spread. So we talked about that a little bit on the show, and I guess I'll rehash it just a tad, and then we're going to look at a Microsoft trade today. But the stock's at 81, selling 2 of the 84s and buying 1 of the 86s. I'm going to send this to the what if calculator, and then we'll come back and we'll look at the alternative trade here. So let me check these boxes so that we can send it right back there to the ticket if we need. Let's go back to the trading page. We're going to remove this one and sell this one. All right. And that was almost double. And there, I guess it's a little less than that. I think we were paying $1 on Friday for that trade. Okay, so that's at 82 cents. So here's the difference. If you do this, if you buy I guess if you do what most people think of when they are trading around earnings, they think of bull call spreads, call vertical spreads, call debit spreads. Those are all 3 different names for the same strategy, where you're buying the 81, you're selling the 84. You can do that, and if you go above 84, you're going to pay 82 cents, and the maximum is the width between the strikes, 81 and 84, $3. So we're selling the 20 delta, which is always usually about where the expected move is at. And if you look at the expected move, we can do the math fairly quick here. 250 plus, we'll call it 290. We'll call it $3, right? Okay, so 250 plus $3 would be around 550. $5 from here is right around 84. So the math all works out, and that's about the 20 delta, and that's usually the case where the expected move comes in at right around the 20 delta, 22% chance of the underlying stock finishing 1 cent in the money above 84. So you're saying that there is a chance, right? You're saying this is my high strike, and there is a chance, there's a 20% chance that the stock might do well enough after earnings that it could close above 84 by the August 1st expiration date. All right. Now you're going to pay 82 cents. So the question is it okay to you if you are willing to add a call to lower the cost? So we're selling 1 more extra call, And then we're going to buy some protection, and we're going to buy this one here to bring the cost down 30 cents. So if I do that and I bring the cost down 30 cents, I have more upside if it lands on 84, if it lands right here or close to that 84 strike, or actually below 84, you have more upside only because you didn't pay as much, right? If it blows through 84 and goes on to 86, 87, 88, 89, I would have done better in the bull call spread, not in the open wing butterfly. But I still would be okay. And now we're going to jump back to the what if calculator, because if we look at the what if calculator, we can make $1 minus the net paid, which is 50. I'm going to say 50 cents, but the computer's going to grab 51, I think. And right here, so you see that if you do blow the numbers away and you go about a 1 standard deviation move, which is right around 86, and that would be a delta of about 16. Well, actually, it's showing up here. It's 18% chance of it. Well, let's just leave it here. Let's stay focused. Okay, 86 is from that point on, we still double on our trade. We still paid 50 cents, and we're still going to be able to sell it for $1. So I like the trade-off because I do think on especially on a percentage basis, right? 30 cents on an 80-cent trade is a big deal. It's a big deal. You still have a ton of upside. In order to get beyond 86, that means they got to blow the numbers away. They got to do more than a 1 standard deviation move to the upside. So I like open wings as an alternative to just a straight out long call spread, especially around earnings. And here's the biggest reason why is we're getting a lot of juice for this 84 strike. Right. We're selling 2 of them. We want to get juice. We want that implied volatility high. And because of that, you get this opportunity where you have this type of upside here. Now, yeah, it's that simple. That's straightforward. Okay, so that's the PayPal one. Do we have any questions at all on that? If you do, please do put them in the chat box, and Luis is going to let me know. Because of our technical difficulties, he's got to jump in and just let me know about these questions. And then let's now go in and look at Microsoft. All right, so in Microsoft, we're the stock is down, and the chart is once again parabolic is a word I've been using a lot lately. But man, a lot of these tech stocks have done that. And Microsoft has had a real strong move to the upside. And so in this instance, again, I'm bullish on Microsoft going on into the earnings. I mean, we're staying above, all the ducks are in a row, right? We're above the 200, above the 50, above the 20. The 20 has been running right along with Microsoft the whole way up. I don't mind getting long Microsoft after their earnings report. I don't think that is, I don't mind owning Microsoft. As a matter of fact, I do own Microsoft. But with that said, I do think that there's a potential here to do a skip strike butterfly. Now, my issue with it is that they're announcing on a Wednesday. We got Amazon announcing on Thursday, and we're probably going to end up doing the Amazon trade also. But I just wish there wasn't 2 full days of trading before the expiration date of the Friday option contracts. So that does make me a little nervous. So I'm trepidatious on that fact. But with that said, let's go and look at it and let's set it up. And this would be a trade that I will revisit on Wednesday. But it is a trade that I would definitely wait until closer to earnings, because if you do get to run up into earnings, because we got 2 full days right before the trade, but I think you'd want to set it up, and I want you to think about it a little bit before that earnings report. But here we go. Stock is at 112. So we're looking at about a 1 standard deviation move. And this is, once again, I've highlighted this more than once, that this is one of my favorite features of the options grid, is that it changes the color of the strikes that are beyond a 1 standard deviation move. So we were right about 540 here. The fact that this is an expensive stock kind of helps this trade out a little bit. You get a little bit more premium because it's a little bit more expensive. So I'm hoping we can get 10 points wide. So let's look at buying the 83.55. We're going to sell 2 of the 45s, 120, 240. Yeah, we're going to have to go 5 on it. Let's look at this. We'll sell 2 of these. And then 5, then we're going to go 550. We're going to buy that one. 20-cent net credit. Okay. So we have a $500 margin requirement. We're going to bring in 20 cents. Now, once again, I'm sending this to the what if calculator. This is an alternative to a short spread. I never think of this type of trade as I want to put this on because I was thinking of doing a butterfly. So I was thinking about doing a butterfly. So I'm going to do a skip strike butterfly. And that's not the case. We're putting this on as an alternative to a short spread. We're bringing in a net credit of 20 cents, and that's the minimum that I would want to get. We have a $500 margin requirement, and we're hoping to make that 20 cents. But if the market does end up settling in this area, we could make more than 20 cents. We'd be able to put this on for a net credit of 20 cents. We could take it off for as much as $5 net credit to the account. Now, that would mean we would land right at 540. So here's the alternative trade. So this is 55.50. Our alternative, if we weren't going to do this skip strike, would be to look at the short call spread. The short call spread is paying for our butterfly, is another way to say it. So let me get rid of these 2 legs and see how much credit we would receive if we just did the short call spread. So let's remove this one, and hit this one. 42 cents. So here's the trade-off. Once again, do you want to pull in 42 cents and not have any hedge at all? The market comes up against you, but it's got to move all the way up to the 10 delta, 10% chance of that finishing 1 cent in the money based off of the delta at expiration. Okay, now I always say that at expiration is important to say at expiration because that is what this is saying. So that's implying that the stock could run up, go above it, and still come back down. It gives that probability. Just so you know, it's not probability of touching, it's probability of finishing at expiration at 1 cent above 545. Okay, 42 cents. Are you willing to give up 20 cents to have the benefit of having a hedge built into the trade? And that hedge, so by skipping this strike in the butterfly, you'd normally buy the 545 strike in our butterfly setup, and that would mean a standard normal butterfly. By skipping it, you put in a $500 margin requirement, but you pay a lot less, right? This is the one you would have been buying. You would have been paying $1.23 for it, but now you're buying an 80-cent option contract. And basically that difference is the reason why you can get it done for a net credit to the account. So I think it's worth it. As a matter of fact, I would never do this trade. Never is a strong word. I don't like doing short spreads around earnings to try to capture volatility because I don't know if the risk is worth the reward. I really don't. I don't know about that because you don't have that opportunity on the huge gaps up to get out and kind of salvage the position. But if we do this trade where we get rid of this, we're going to get rid of the 5. I'll just start it all over again, right? So we did 535. Okay, so let's clear it out. Oh yeah, we got it in the what if calculator. So if we do this trade, let me go back. Net credit of 20 cents. You're giving up 20 cents. Giving up 20 cents with the potential hedge of making $5 if it landed somewhere between 535 and 540. Now, here's the catch from the what if calculators. Realize it's still like a short spread. If we put it on today and the market goes against us and hits our short strike tomorrow, without that event happening, right? And we get all the way up to that, we're still going to be down on the trade. We'd be down more if we just did the short spread, but we're still going to be down. We need time decay to happen. We need implied volatility to come in to make this draft up towards that peak of our skip strike butterfly. We need that to happen. So hence the reason why if I'm doing this type of trade, I'm going to lean to do it on the day of the event. I want to put it on. I want the event to happen. I want implied volatility to get sucked out of the option contracts, and I want time decay to start kicking in. So Amazon is always the ideal candidate. If you got the same forecast, I'm not going to force it, right? But if you have the same type of forecast with Amazon that the parabolic move is too much to the upside and it might give back, might even have good earnings, but it still might give back, some of that win just because of the opportunity to get out of the stock on people that are in it for the short term as opposed to the long term. So there you go. That's going to be our paper trade in this scenario. We are going to be buying the 535 strike call, selling 2 of the 540s, buying 1 of the 550s. We're hanging out right around the expected move on the upside. That's where this starts. This is about the 1 standard deviation move. Where is our 540, right? Right at the 15 delta. So that's about a 1 standard deviation move. Saying there's a 15% chance that the stock would finish 1 cent in the money above 540. Our risk kicks in at 545, which is the 10 delta, 10% chance. And then our max loss occurs at the 8 delta, 7.5% chance. All right. So can it happen? Once again, I always want to try to equate this to the weather. I mean, how many times have you gone out and the weather forecast says there's a 10% chance for rain and then it rains all day long? That happens. So keep in mind that this, don't bet the farm on this. There's a low probability of it happening, but when you have an earnings catalyst, there's no way that the marketplace can exactly predict that type of earnings. All right. Now you say, well, okay, Brian, why don't we do this then when there's not an earnings catalyst? Well, you're not going to get it done. That implied volatility won't be high enough to be able to get this done and bring in at least a decent net credit of 20 cents. And it's that simple. So you do it around earnings. Ideally, you do it on a Thursday before a Friday, so you have a 0 DTE option. But if not, it is what it is. And this is where we're at. All right. Any questions, comments? Thanks for hanging around for our little issues that we had this morning, but we'll be back this Wednesday. We'll review this trade again. And Meta is also going to be announced earnings, and I'll probably throw together just a long call spread. So if you are bullish on Microsoft, you can look at just doing a long call spread as an alternative to this trade. So we'll put one together on Meta, and we'll put one together on Microsoft this Wednesday. We'll do an additional trade above and beyond our skip strike butterfly. Thanks for tuning in. We'll see you Wednesday inside the hub, hub.tradier.com at 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.